Hello and welcome back. I'm Shubham Thakur. In this first part of our three-part dive into healthcare terminology, we'll unpack the financial terms you encounter when choosing and using health insurance: premium, deductible, copayment, coinsurance, cost sharing, and the out-of-pocket maximum.
So that's our game plan. Let's start with the first, most consistent cost you'll come across.
And that first cost is your monthly premium. The simplest way to think about this is that it's your price of entry, the cost to have health insurance in the first place.
So, what is a premium? Well, it's that fixed, predictable amount you pay your insurance company every single month. It's a bit like a subscription fee. And just like any subscription, you pay it to keep your service, in this case your health coverage, active regardless of how much you actually use it.
Now, here's a really important point. That premium is just for access. It gets you in the door. It doesn't actually cover the cost of the care itself. That's where all the other pieces of this financial puzzle come into play.
So once you start using your insurance for medical care, you'll run into what you can think of as the first hurdle. And that hurdle is your deductible.
Your deductible is the specific amount of money you have to pay out of your own pocket for covered medical services before your insurance company starts to contribute. It's a figure that almost always resets once a year.
Let's make that real with an example. Say your plan has a 20,000 rupee deductible. That means you are responsible for paying the first 20,000 rupees of your medical bills for that year. Only after you've spent that amount does your insurance plan begin to share the costs. So, the big question is, what happens next? Once you've cleared that deductible hurdle, you move into a new phase. This is where your insurance really kicks in, and you start sharing the costs together. And this next phase is all about that partnership, about sharing the cost. You're no longer shouldering the entire bill. Instead, you and your insurer pay for services together. And this happens in a couple of different ways.
First up is the copayment, which you'll probably hear called a copay. This is probably the simplest form of cost sharing. It's just a flat, fixed fee you pay for a specific service, usually right when you get the care, like at a doctor's office.
For example, your plan might have a 500 rupee copay for a regular doctor's visit. So when you go to the doctor, you pay 500 rupees. That's it. It doesn't matter if the total cost of that visit was 2,000 rupees or 10,000 rupees. Your part is that one predictable fixed amount.
Now, the other side of this coin is something called coinsurance. This works a little differently. Instead of a fixed fee, coinsurance is a percentage of the total bill that you're responsible for paying, again, after your deductible has been met.
Let's look at an example. Imagine you have a 10,000 rupee medical bill and an 80-20 coinsurance plan. This means the insurance company pays its share, 80% or 8,000 rupees, and you pay your share, the remaining 20%, which comes out to 2,000 rupees. With coinsurance, your cost changes depending on how big the bill is.
So to boil it down to the main difference, a copayment is a flat fee. It's predictable. Coinsurance, on the other hand, is a percentage, which means it's variable. Some plans use one or the other, and some actually use both for different kinds of services.
All right, with all these different costs piling up, deductibles, copays, coinsurance, you're probably wondering, is there a limit? Well, yes, there is, and it's a really important one. It's called the out-of-pocket maximum, and it truly is your financial safety net for the year. This number represents the absolute most you will have to pay for covered medical services in a single year. Once the total you've spent on your deductible, copayments, and coinsurance hits this maximum limit, your insurance plan steps in and pays 100% of your covered costs for the rest of that year. So let's quickly trace that whole spending journey. You start the year paying 100% of your costs until your deductible is met. Then, you move into the cost-sharing phase with your insurer. And if your medical needs are high and your spending eventually hits that out-of-pocket maximum, you reach the final stage. From that point on, your insurer covers everything. It's a vital protection against truly catastrophic medical bills.
Now, all these payments we've been talking about, the deductible, the copays, the coinsurance, they all fall under a single umbrella term. That term is cost sharing. Let's just define that clearly so it all clicks into place.
Quite simply, cost sharing is your share of the cost for the actual healthcare services you receive. It's the money you pay when you use your insurance, and it specifically refers to those three key components: your deductible, your copayments, and your coinsurance.
And just to be crystal clear, your deductible, your copayments, and your coinsurance are all forms of cost sharing. But your monthly premium, that's not considered cost sharing. Remember, that's just the price of access. And naturally, anything your plan doesn't cover at all, that doesn't count either.
These terms work together.
You pay a premium for coverage, a deductible before benefits kick in, a copay or coinsurance for services, and there's a cap on your total spending.
In the next video, we'll explore terms like allowed amount, balance billing, claims, and the explanation of benefits. Stay tuned.